Hello, this is Jeremy Capron. I'm talking to you from New York, and we'll jump straight into Robo. So, Robo had a excellent end of the year. The index was up 24% in Q4 and a total 45% in 2020. And that came after a rise of 30% in 2019. So really, the performance has been very good over the past 2 years. If you look at the performance over the past quarter, the past year, the past 3 years, the past 5 years, annualized returns have been largely in excess of global equities. So um, let me talk a little bit about the Robo as an index portfolio. Um, Robo is a research-driven index of the best-in-class robotics, automation, and AI companies from around the world. And it covers the entire value chain from the core enabling technologies like sensing or computing that make the automated systems possible to some of the most promising applications across manufacturing, logistics, healthcare, consumer, etc. And this is what is shown on the pie chart here, where you can see the breakdown of the portfolio by sector. And in green are the enabling technologies, in blue, the applications. Um, all of the 11 subsectors of the index delivered positive returns in Q4. We saw 3D printing up 76%, security up 45%, and manufacturing industrial automation up 31%, leading the gains. And at the bottom, you can see that consumer and logistics lagged the rest of the portfolio. In terms of regions, we saw that US stocks really outperformed. Strong contributions from stocks like 3D Systems, Brooks, Zebra Technologies, Ambarella. I'll get back to that. Also, China and Taiwan really stood out. And I think that's a reflection of the rapid improvements that we saw in factory automation, especially in the electronics industry, and that benefited companies like Shenzhen, Innovance, Delta Electronics in Taiwan, or AirTac as well in components for factory automation. In terms of the best performing stocks in the quarter, I'd like to highlight 3D Systems that more than doubled in Q4. 3D Systems, a leading provider of 3D content to print solutions. That's 3D printers, that's 3D printing services, the materials, the consumables, etc. And really the stock bounced hard from the low point that it hit in September, multi-year low. We're starting to see some positive improvements at 3D Systems. They're reduced their cost structure, lowering headcount, but more importantly, we're starting to see the business trends significantly improving, and their revenue in the third quarter was significantly above expectations. Just a few days ago, they raised the outlook once again, and they've also made some interesting changes in terms of refocusing the portfolio and getting out of some of their software businesses that were non-core. Also, Ambarella was up strongly in the quarter. Ambarella is a leader in video processing chips. We think that company really hit an important inflection point in recent months. They are morphing into an AI company with computer vision capabilities that are attracting major players in the automotive industry. So the company announced that they have more than a $600 million funnel of business opportunities with automotive manufacturers and suppliers. So increasingly, it looks like the market may be starting to realize that Ambarella's technology is not just about video processing for surveillance cameras, but that there is a strong potential in the auto market for advanced driver assistance and autonomous vehicles. Also want to highlight that the performance really is evolved during the year. In the second and the third quarter, we saw that the key beneficiaries of that turbocharging of digitization across the economy led the gains for Robo. And businesses striving to operate in new ways safely and efficiently during the pandemic. So the technology providers were really the stocks that did the best in that period. In the second and third quarter, AI-powered technologies, logistics and warehouse automation. We saw that the sensing and health technology stocks did particularly well. But in Q4, we saw that the breadth of performance really expanded into the more challenged areas of automation during the downturn, and that's namely the industrial sector. So I talked about the strong recovery in 3D printing stocks, but we also saw very solid gains at factory automation companies like Teradyne, like Brooks, Harmonic Drive, and Highwind. So that's important because our base case for 2021 is that we're going to continue to see that the economic recovery gathering steam and more areas of the economy recovering from the lows of the lockdown lows of about a year ago. Now I want to make a few comments on the portfolio itself. On the next slide, yes, you can see that the top 10 holdings for Robo on the right-hand side, and that really reflects the diversification in the portfolio. The top 10 names in Robo account for only 16% of total. And you can also see the diversification in terms of sectors. We have software businesses, we have healthcare automation here with Vocera, we have a Taiwanese-based component supplier, Highwind, we have a Japanese sensor company, Keyence, we have a US computer vision company with Cognex. So that diversification, not only in terms of the number of companies in the portfolio, but also in terms of sectors, in terms of geographies, with more than 12 different countries represented in the index. And the vast majority of these companies are not in traditional stock indices. You can see on the left-hand side here the overlap with traditional market indices very low. Overlap with S&P 500 or the MSCI World Index is low, just around 3%. So investors generally don't own these stocks. And on the next slide, you can see that strong tilt towards small and mid caps. They represent more than half of the portfolio. And that's important in the current context. If you believe, like us, that we are in the early stages of a broadening economic recovery when small caps typically outperform. And by the way, in Q4 of last year, Russell 2000 had its best quarter ever. So certainly important to consider the composition here in terms of the market cap. It's also important because that's where a lot of the M&A action is taking place. And 2020 was a banner year in terms of M&A in the robotics and automation space. That was the case for Robo, where we saw 7 of the 80 plus companies receiving takeover offers. And there's a list here. You can find more details in our quarterly report that's available, I think, in the chat box here, if I'm correct, and if not, it's available on the website. Finally, before I pass it on to Nina, I want to discuss some of the ideas that we present in our annual trends report that was just published, and that's also available on the website. And this idea is that 2021 will be a boom year for factory automation. And I think I've already touched a little bit on that, how we're starting to see strong gains in terms of manufacturing output, and how the factory automation stocks have really starting to move up in Q4. The reason why we think 2021 will be a particularly strong year is that the prior 2 years were essentially a disaster. And it's not just 2020 when the pandemic hit supply chains and factories around the world, But before the pandemic hit, we had been going through a nearly 2-year downturn in terms of manufacturing activity around the world. And so the low of the pandemic really happened at the end of a down cycle, and we think that will make the up cycle all the more stronger. And if you think about what the factory automation business represents, I think it's fair to say that's about 40% of the Robo Index that relates to factories. In terms of the installed base of factory robots around the world, we think that by the end of the year, it will exceed 3.2 million units. That may sound like a big number, but when you put that in a perspective, it's not. And that perspective I'd like to give you is the number of manufacturing workers all around the world. That's more than 360 million. So we'll have 3 million robots for 360 million manufacturing workers. And that, to me, essentially means there's a long runway for future growth there. The corollary to that is that China will remain the top story in factory automation this year. It's already been the top story for a few years now, and the Chinese market's the largest when it comes to factory robots, represents around 40% of global demand. And China came out of the COVID crisis first. And what we're seeing in recent months, what we're hearing from our companies involved in the space is that things are getting better week after week. And in fact, if you look at global manufacturing indicators like a PMI, they're the highest level in a decade, and first and foremost in China. So we expect the China-related names in our portfolio, and they can be Chinese factory automation, or they can be Japanese factory automation companies that export into China. We expect that area to be particularly strong this year. So there's more details in our trends report. I strongly encourage you to download it and come back to us with your questions. Before I pass it on to Nina, I want to highlight once again that you can ask questions. We'll be happy to make this discussion as interactive as possible. So use the Q&A box at the bottom of your screen. And with that, I'll pass it on to Nina to talk about HTech.
Great, thank you, Jeremy. Yep, so I'm going to go over HTech's results, and then similar to Jeremy's format, we'll talk a little bit more forward-looking about 2021 trends. So looking back, HTech is the green line there, and what we're seeing is some pretty strong performance, notably that there was healthcare stocks in general. They did continue to outperform both global equities and the broader healthcare categories in Q4, as well as for the full year 2020. So the ROBO Global Healthcare Technology and Innovation Index, ticker HTech, returned more than 25% in Q4. And for the year ending 2020, HTech returned 66.5%. And this compares with 16.3% with the MSCI AC World Index, and 13% for the S&P Global Healthcare Index. So, and we'll also note that in December, HTech achieved its first 100 million in assets milestone. We launched this strategy in June of 2019, and it's been really, really fun to watch this grow. So, we want to thank all of our investors for their interest, and we're really excited about that milestone. And we hope that there's more to come. So, so when we look at this performance, we ask, well, what's driving this? So let's take a closer look at the portfolio. As you can see in the next slide, there are all 9 of our subsectors delivered double-digit positive returns in Q4. With genomics up 42% and precision medicine up 36%, leading some of these gains. And so when we take a little bit of a closer look, what was going on with genomics? A lot of excitement. There was over $10 billion in M&A transactions as various H-tech companies pursue the early cancer detection market with regards specifically to liquid biopsy and other ways to diagnose cancer earlier. Large gains were largely led by CareDx, a company that we brought into the portfolio last year, up 91%. And they are a technology leader in transplants, transplant testing, and they reported strong Q3 results. They also received some positive news for Medicare reimbursement pricing for their heart cell-free DNA test. And in precision medicine, the strong performance was driven largely by milestone achievement among different H-tech CRISPR leaders, such as the advancement of treatment for sickle cell disease with a company called Editas. There was also the advancement of the world's first mRNA therapies for COVID-19 vaccines, which H-tech's Moderna launched at the end of the year. So we largely believe that the advancements that have been seen this year in genomics, precision medicine, telehealth, even represent a long and steep adoption curve, and we expect to see transformative disruption in these areas over the next decade. And we could just take a quick look at the next slide and just recap a couple of other things that we think are sort of really instrumental to the performance here. If you look on the left, you'll see the overlap with H-tech relative to some other comparable indices. For example, the S&P 500, MSCI's ACWI index, and then global healthcare indices. And as you see, less than 5% overlap with some of the most popular global indexes, and less than 16% overlap with healthcare indices. So there's really something unique happening within the H-tech portfolio. If you look at the right, you'll see that of the top 10 holdings, there are a lot of companies here that are potentially not represented in a lot of other healthcare portfolios. So by having H-tech in your portfolio, it does truly diversify from what potentially is already in there, even if you have exposure to other healthcare stocks. And in fact, if you go to the next slide, you'll see the other thing that results from our methodology is that when you target and look for the innovators and the disruptors in the healthcare space, you do wind up with a portfolio that is more heavily weighed in mid and small cap names. Almost half of the portfolio is weighed in mid and small cap. So again, another way that you're potentially going to get exposure to companies that you might not otherwise have in your assets. So then if we could just jump to the thematic section. When we look here, this is something that has become very commonly known to people around the world that maybe a couple of years ago or 4 years ago might not have been as commonly known. And this is the telemedicine industry. And the pandemic certainly accelerated adoption for this theme. Probably advanced it by 4 to 5 years, with more people using telemedicine to see a doctor this year than ever before. Now, there will be an estimated, let's say, $30 billion that will have been spent in the telemedicine industry in 2020. However, this is only just the beginning of a much broader category theme of telehealth or even virtual care. So we're not just talking about doctor-patient visits as the broader opportunity. We're talking about a large infrastructure of connectivity between not just doctor-patient visits, but doctor to doctor, device to doctor, device to patient, patient to family, doctor to family, device to device. And that requires a lot of technology infrastructure. And there are a lot of companies that are already very well positioned to capitalize on this very fast growing theme. In fact, McKinsey expects this broader virtual care category to represent a $250 billion opportunity. So, so we've only just scratched the surface with this year's adoption of telemedicine, and H-Tech is particularly well positioned for the growth in this theme with market leaders and pioneers such as Teladoc, another company based in China called Ping An, and Nuance is another leader in this space. And so much more to come in telehealth over the next 5 to 10 years. And so we feel like we're really well positioned there. And then another great theme that we already mentioned earlier is all the exciting things happening in genomics. So one subcategory of genomics is this early cancer detection theme that we discussed earlier. An estimated 100,000 lives can be saved each year if you can diagnose people earlier with cancer. And so, as I mentioned, there was over $10 billion worth of M&A that took place within the H-Tech portfolio alone this year. And this is companies like Exact Sciences, Illumina, going after this estimated $75 billion market opportunity over the next 15 years. So what is it when we talk about liquid biopsy? Well, to simplify, let's just say that when you go to the doctor and you have your blood drawn for a routine blood exam, they can also draw blood and have a very deep, closer look at it at a molecular level. And so hence when you see this blood tube here and it looks like you can see some genomic information within it, that's exactly what's happening with genomic testing. So we've already seen a huge adoption globally of prenatal testing. This is people who are pregnant, they can have their blood drawn and you can actually look at fetal DNA. And so now there's a huge opportunity, a fast growing opportunity where you can draw someone's blood and you can look for tumor DNA. A cancer tumor does shed its cells into the rest of the human's blood. So by capturing a blood draw, you can analyze it at a much more molecular level and look for cancer DNA. And not just with one cancer, but over time, the goal is to be able to draw someone's blood and look for 15, maybe 20 different, maybe more different types of cancer in lots of organs all in one go. So imagine just during a routine doctor visit that you can get screened. And if we can capture more cancer earlier, we can save lives. And so huge market opportunity. A lot of this is still in research and development right now, not yet commercialized. Hence, if you go to the doctor tomorrow and just say, can you screen me for 10 different cancers? We're not there yet. But these companies are very quickly developing and heading in that direction. And this is a really exciting time to be exposed as well to some of these stocks. Natera, Illumina are ways through the H-Tech portfolio. I mentioned CareDx earlier. These are all fast growing companies and pioneers in this space. So much more to come on that over the next decade as well. And I think it's time to turn it over to Lisa to talk about Think and our AI strategy.
Thank you, Nina. Think Index, just to reiterate, is a strategy that captures the mega trend of artificial intelligence as companies small and large are seeing acceleration and growth from the adoption of AI. THNQ is the newest strategy of the ROBO Global family, officially launched in the US last year. For the fourth quarter, Think Index posted a strong gain of 24%. For 2020, Think Index surged more than 68% for the year. It continues to outperform global indices such as MSCI World and broader market indices such as S&P 500. Even in backtesting to 3 and 5 year figures, THNQ continues to outperform, up about 37% on an annualized basis. During the fourth quarter, all 11 subsectors deliver strong returns, driven by outstanding performance in healthcare, up 46%, network and security, up 38%, and cloud providers, up 31%. But if you look at the past 12 months, however, e-commerce and cognitive computing were the strongest performing subsectors. E-commerce grew almost 147% for the year, and cognitive computing subsector rose 131%. In fact, all of these subsectors delivered double-digit returns for the year. And what is driving this outperformance for Think Index is that the overall demand for cloud solutions combined with AI capabilities continues to gain tremendous momentum. Many of these index members were seeing increased spending around cloud projects before the pandemic. But the deployments and migration we're seeing that has really accelerated beyond what many of the companies possibly imagined. Cloud enablers strongly benefited from the acceleration in cloud migration, driven by work from home cultures, combined with digital initiatives from enterprises around the world. For example, Cloudflare, one of our index members, is a cloud infrastructure and website security company, and their products are grounded in machine learning. Cloudflare is benefiting from the shifts that we're seeing in AI, data center, IoT, and 5G, to just name a few. Shares are up over 300% in the past 12 months. We strongly believe that spending around cloud capabilities and AI systems will continue at a rapid rate in 2021 and beyond. And Think also, it's very important to note that Think has a very low overlap with the MSCI World Index, as well as S&P 500 and various competing indices. Our top 10 holdings are truly unique, and it captures all of the companies are enablers and developers and users of AI with high revenue and investment purity around artificial intelligence capabilities. Those are some of the key factors that we look for in the member selection process for Think, and we think that makes us quite unique. Think also has a very diversified market cap exposure and also in geographic region as well. Think Index captures the broader AI ecosystem around the world, with almost 30% of the companies being outside of the US, and also in various market caps. It does have a bigger tilt to the larger market cap versus the H-Tech or the ROBO strategies. And we believe that in order to develop and build AI systems, you need quite a bit of resources to build your own AI team of experts and developers. Some of these index members are basically designing their own processor chips and building their AI ecosystem. So we do believe that the larger cap tilt is as an outcome of finding the companies with real high revenue purity around AI. However, if you look at the top 10 holding list, about half the companies have market cap between 2 to 8 billion. So it is a pretty good diversified group of companies. And in terms of portfolio characteristics, companies in a Think strategy tend to have a higher valuation and increased volatility versus a company in the ROBO index. And the reason for that is the Think Index members are pure play, AI-driven companies are developing sort of the building blocks and leveraging machine learning capabilities. So enterprises can improve their productivity enhancements, drive cost savings, and go after massive revenue opportunities. With faster sales growth being generated, these companies have higher investments as well, related to R&D and CapEx, as well as higher sales and marketing. So we believe that meaningful operating leverage is there if they need to scale back on spending. It's also important to note that over 67% of index members for Think have net cash positions. So that's a real unique attribute to Think. And all of our strategies actually have a very strong balance sheets and very good financial positions. And to share some thoughts on what we're anticipating for this year, we want to share a couple themes for Think that really stood out for us. Obviously, it was a major year for e-commerce, and we think the overall trend will continue. Retailers had to really up their digital game this year, as the global lockdown has really magnified the importance of having an online presence for business just to survive. For 2021 and beyond, from our conversations with various management teams around the world, we're actually hearing more spending around e-commerce platforms, especially in areas like connect merchants with its customers, especially the first-time customers who are new to online shopping. And these companies are looking for more advanced analytics system, more AI, more autonomous, more machine learning algorithms to really get customer insights and shopping behavior. We're seeing that the retailers are really hungry for customer data. And a lot of this data is already out there, readily available. And we just need some machine learning algorithms to sort of analyze it and help predict what the shoppers want and figure out some of the buying behaviors as well. So this is where we think that machine learning could really transform the retail industry, online and offline. We think solutions around omni-channel capabilities, order fulfillment, customer relationships, smartphone, mobile payment system, anything touchless, and personalization tools will really benefit from increased spending. So the Think Index members like Square, Spotify, Yandex, Etsy, and Mercado Libre, we really believe that they're strongly positioned and should benefit from these long-term secular and structural growth opportunity. These are companies that are leveraging AI capabilities into their e-commerce platforms to help businesses engage with customers and help facilitate their transaction. So that's a very interesting trend that we're seeing for this year and beyond. The next slide, without a doubt, it was clear that 2020 was the year of cloud computing. And we believe 2021 and beyond will be the era of artificial intelligence. As the deployment of cloud surged this past year, we're seeing signs of companies struggling with managing and accessing all the data and managing their applications that they have deployed into the cloud. Large cloud vendors are generally not known for best-of-breed solutions, but enterprises had no choice but move their data and applications using the cloud vendors because they had the capacity. As we look out into this year and next year, we're seeing traditional IT environments really quickly being replaced with a modern network environment with advanced capabilities beyond just simple cloud environment. We're seeing signs that enterprises really want solutions that are more autonomous, touchless, and powered by AI engines. They want faster data access using next generation storage solutions without compromising security. So organizations are rethinking their IT strategy this year, and we believe that they're going to adopt a very modern environment that will have a very simple infrastructure, whether it's a hybrid environment or purely public cloud or even a micro cloud, but it will be probably a combination of all three for most large enterprises. So this multi-cloud environment that is emerging, and it will be powered by AI to help with lots of the operational efficiencies, gathering and retrieving data and having it more autonomous. So you could have the workers focusing on other operational needs. And on top of that, the biggest data breach in the US history was discovered last quarter in Q4. So cloud-based security companies that are powered by AI are experiencing meaningful growth right now. And they're strongly positioned to benefit from this increased security spending that we're predicting to prevent future attacks. We believe we're in very early stages of this increased spending around new types of cloud-based cybersecurity solutions. And many of our index members, like in the network and security subsector, like Proofpoint, Palo Alto, Varonis, Arista, and Pure Storage, are companies that will strongly benefit from the structural shift that we're about to witness in building this modern IT architecture. So those are some of the things that we have highlighted in our 2021 trend report that could be easily accessed after the call today. So I'm going to pass this on to Jeremy. Thank you.
Thank you, Lisa. So we'll move on to the Q&A part of the call. I see we have a number of questions in the Q&A box. Please feel free to type in your question if you have any. And I see there's a couple around the index methodology and the company selection process. I think we'll start with that, and then we'll move on to the questions around Think. So let me take the first one. Can you discuss the index methodology and company selection process? I like to describe our process as a hybrid with on one side, a very strong research component. That's the basis for company selection. So our research team monitors around 350 public companies that we all analyze and score on a number of metrics that determine index eligibility. And the research process starts with understanding the business structure and how much of revenue can be associated with the sectors that we described earlier. So Robo has 12 different sectors, Think is 11, HTech is 9. So we'll look for high revenue association with those relevant sectors. And then we also score companies on their market leadership and technology leadership. Those are two relatively subjective measures, but they tend to strongly correlate with long-term financial performance, meaning if you are a dominant player in terms of your technology leadership, in terms of your market share, that tends to translate into strong financial performance. So we constantly score those companies. How do we do that? We do traditional investment research and technology research. We interact with industry experts. We meet with the senior leaders of all those companies. And ultimately, that comes down to a score, and that score will determine index eligibility. So that's the research side of the process. I like to say it's a hybrid process because we combine that with the benefits of index investing. So we have a modified equal weight across the portfolio that gives a very strong representation not only to large established companies, but also the smaller up and coming ones. And every quarter will rebalance. So automatically the portfolio will go back to that initial modified equal weight that's driven by the scoring system. And that means we'll sell the stocks that have gone up a lot and we'll buy the stocks that have gone down more than average. So there's this embedded process that really smoothes the ride from point A to point B. And that works really well with the ETF wrapper. I think that covers also how frequently is the portfolio rebalanced. That's every quarter. Let me shift to Think. I see we have a few questions around Think. How does the Think and Robo index differs? Lisa, do you want to take that?
Yes. I think the biggest difference is that Think strategy really captures the AI as a primary focus of the business. So we look at the real high purity, revenue purity around these companies. Are they enablers and developers? Are they users? But even within that, we go deeper into how much of the revenue could be really contributed coming from artificial intelligence. We also look very deeply into the investments, companies that have acquired AI systems or AI technologies, or even developing their AI in-house. We look even for job postings as well as to, are they hiring data scientists to lead their team? So we do a lot of a very big focus around just artificial intelligence. It is a pure play strategy, while the Robo Index really focuses on the robotics and innovational impact on robotics and automation AI. And AI is just one part of the ROBO's focus. So I think that you should think as more of a spin out of the AI category. And we found that there were meaningful companies that were really driving the revolution, as well as companies that are using AI, but going after massive revenue opportunities. What are the similarities between the two strategies is that it's very diversified in nature, as well as companies have to have technology leadership as well as market leadership. So those kind of key metrics and factors haven't changed.
Thanks, Lisa. There's also a question around the potential delisting of Chinese firms and how that could disrupt Think from owning stock like Baidu.
Yeah, so we definitely currently looking very closely into all the information surrounded that. So we do have some risk management process in the Chinese companies that are delisted. Currently, some of the thought process that we have is some of the large players like Baidu, like Alibaba, we feel strongly that they will not be delisted, but it is something that's evolving in nature. And it is something that we're having lots of discussions probably on a weekly basis, right, Jeremy?
Yes, and I would add that the index can own the stocks in their country of origin. So Baidu is basically a US listing. A lot of the Chinese companies are moving towards a dual listing. So we've seen that with Alibaba raising money in Hong Kong, and now with that dual listing. So we think there's flexibility around where we can own those companies. And I would just add a comment around the China mainland companies that are listed in Shenzhen or Shanghai. Until 2019, it was difficult for us to include those companies in our strategies. But starting in 2019, we have been onboarding some of the China listed firms in Robo. So there's a cap factor to limit the overall ownership of those stocks, because they still present some difficulties in terms of custody or in terms of trading. So today in Robo, we have about 2.5% of the portfolio that's in China mainland listed stocks. And I think we'll move on to Nina. There's a question around H-Tech and how COVID-19 has impacted the portfolio.
Sure. I think that this was a really, I guess, unique year for many reasons, obviously, but for healthcare innovation in particular, that, as I mentioned earlier, telehealth, for example, one of our 9 subsectors, that there was some acceleration and adoption in some technologies that have been on the slower end of the uplift scale over the last 5-10 years. And so I would say overall that the pandemic cast a spotlight on technologies that do exist, but had an opportunity to be further adopted. So, like, telemedicine's been around for over a decade, and a lot of people, we conducted a survey, didn't even know what it was in the last couple of years. So that's just one example. But when we look at genomics, the ability to sequence this virus so quickly when it was first discovered and know, wow, this is new. This is a new novel virus that we have not seen before. That is utilizing technology. Illumina sequencers were the first to identify what this even was. And so we have the leaders and the pioneers in these areas like precision medicine and genomics and telehealth. And so the key is that whenever there is an event, and let's hope that there isn't an event like this again for a very long time, but when there's something macro that might occur, or something that's going to require um, advanced healthcare technology, the key, and this is what one of the reasons why a benefit to the portfolio is that if you are already having exposure with these large companies, or these leaders, I should say, the innovators, then those are the ones that wind up being present and already deployed when they're needed most and called upon. So like, let's look at the diagnostics companies. They performed also very well within our portfolio this year. Companies like Abbott and Diasorin and so many, Becton Dickinson, that were very rapidly coming up with COVID-19 tests, and not just PCR tests, but antigen tests. Quidel was another leader there. And at-home tests are now very quickly coming to market. And so rather than chasing after these ideas as they're being developed, if you're already positioned with the leaders and the innovators, then when they innovate and bring new things to market, you're already present in the investment opportunity. So yeah, pandemic absolutely accelerated the adoption of a lot of different types of technologies. Moving forward, I think, is what's most interesting here. Now that we've identified the gaps in care and where we can do better as a society, for example, more deployment in virtual care, more friendly legislation to help adopt certain technologies, look at research and development. So I think we can probably expect to see, especially with the new administration, a lot more funding go toward research in the genomics world, and that's going to fuel another 5+ years of adoption and innovation in genomic advancements. And then when you pair that up with companion diagnostics, and we have exposure to that through our precision medicine category, we're going to start to see a lot more therapeutics advance. And I think at a faster pace than they were before, given what we had the opportunity to see with coronavirus, that a vaccine came to market, multiple vaccines came to market within a year, is very unprecedented. Regeneron has a therapeutic that helps mitigate the impact and the severity of coronavirus. So until everybody gets a vaccine, at least there is a treatment now that's being put into the market that's going to help lower the burden of hospitals as we speak. And Regeneron's another category leader in the Age Tech Index. So now that we've seen how quickly the FDA can move, and CE marks and the world can move to identify and develop new therapies, people are going to expect it more. And so I think we're going to see rapid advancements become the new norm. And so it's a very good time to have exposure to healthcare innovation.
Thank you, Nina. I see there's a couple of questions around valuations, and particularly for Robo. Are we concerned about the current valuation? And then some questions around US versus international and Japan valuations in particular. So I think big picture here, certainly the headline PE on Robo has reached level that I'm not surprised, those questions are coming up, right? The headline PE for Robo is now 33 times. The average since we started Robo in 2013 is 23 times. So we have about a 10-point gap between the current valuation and the long-term historical average. And that may seem like, those stocks are all very expensive. However, I would point out that the next 12 months forecast EPS for Robo right now is nearly 30% below the prior high that was reached in 2019. So we have a relatively high PE, but we have a totally depressed EPS. And I think that Robo can certainly grow into that multiple as earnings recover. In fact, the current forecast for EPS growth for 2021 is 25%. So we're looking at 25% EPS growth this year, followed by another 20% plus growth in 2022. So overall, I'm not too concerned about the current valuation. Now, if you look under the hood, yes, US stocks have higher multiples than international, and Robo is 55% international. So you find markets like Japan still relatively low multiples, and that's where we think a lot of the action is going to take place in 2021, particularly around the factory automation stocks. So long answer short, not too concerned about the multiple at this point. Let me move on to, there's another question around the back testing of the Think portfolio is how does it work given that the index evolves over time as new companies emerge or fall away? You want to take that, Lisa?
Yes. I mean, we take a very long-term view on these strategies, especially also the artificial intelligence index. So you're not going to see not going to see general rebalance quarter, 5-6 companies coming in and 5-6 companies coming out. So far we've had very small, modest changes. It is more concentrated than the other strategies. We have a database that calculates some of the back test calculations based on the index that was constructed initially about a year and a half ago, as well as current strategy. So we have our own screening process that does all those calculations, but you're not going to see meaningful changes that's going to skew some of the numbers in a wide swing.
Yes, and I think that partly answers this other question about the lifespan of a portfolio company in both Robo and Think. Typically, companies are in for the long term. The reason why a company could come out of the index is, in many cases, historically, that's been a takeout. Right? I've mentioned that we had 7 takeouts last year. In fact, since the beginning of Robo in 2013, we've had 24 or 25 takeouts. And so a company would be excluded once it's acquired. Another reason why it could come out is if there's an important corporate action, and it could be a spin-off or a merger, as I mentioned. Or it would have to be the score of the company falling down significantly to a level where it becomes ineligible to the portfolio. And that does happen. We've seen companies lose their technology leadership or their market leadership, leading to a lower score. But it really happens at the margin. And as Lisa said, typically you'll see 1 or 2 companies coming in or out of a portfolio of 70 to 80 stocks every quarter. I think in the interest of time, we're going to leave it here. If you have any more questions, you feel free to send it to us at info@roboglobal.com. We'd be also very happy to see you subscribe to our bi-weekly newsletter in which we share some of our research on companies, on sectors, and on the indices as well. And I just have to say thank you very much for joining us today, and we look forward to speaking to you again soon. Goodbye.
Thanks, everybody.
Thank you. Bye.